Hi guys, Joe Neighbour here at Signal Centre. I'm going to be running through a short webinar on hammer candles for you all today. I went through bearish and bullish engulfing candles last week. So just moving on from that and going to talk about hammer candles. Just going to share this with you. There's me looking a bit smarter. No need to get ready these days. I might treat myself to a shower after this actually. It's been a couple of days. I'm sure a lot of you are the same if you're locked in. So hammer candles. Okay, first mistake. That should say hammer candles. I'll change that. But what I'm going to go through is just an introduction on hammer candles, talk about the psychologies behind the pattern, going to talk about the bullish hammer in a bit more depth, then talk about some trade examples, talk about combinations and where you should be looking to find hammer candles and where they work potentially best, and also talk about some entry and exit strategies using the hammer candle. So firstly, the introduction. Now, the hammer is a candlestick that has a small body with little or no upper wick. So as you can see there, we've got a body of the candle, very small typically. And it's also a requirement that the long wick is at least 2 times the length of the body of the candle. So as we can see here, what I've got is an inverted hammer and a hammer candle here. So we can see that the length or the wick of the candle is at least 2 times the size of the body of the candle. Hammers can be bullish or bearish. As we can see here, we've got an inverted hammer, which happen at the top of uptrends, and a hammer, which happen at the bottom of downtrends. Bearish hammers referred to as inverted hammers, or often can be talked about as shooting star candles as well. And hammer candles usually signal reversals in price. Now, if we talk about the psychology behind the pattern, they typically occur at the end of a trend, and a price usually makes a move above the high or below the low of the previous candle. So as we can see here on this example on the right hand side, price has been moving lower. We've made a new low, and then the price has come all the way back to close at the high of the period. In this instance, I don't know, maybe say it's a 60-minute candle. Now, hammer signals potential capitulation by the buyers or sellers to form a bottom or a top, and that is accompanied by a reversal in price action. So again, go through the psychology of this candle. We've been moving lower. We've opened here at the beginning of the body of the candle. The price has made a new low by going all the way down to these lows before then coming all the way back. So buyers have found some interest around these levels, pushed it all the way back higher. We've then gone above the open of the candle and closed strongly into the close of the period. So that is a nicely formed hammer candle, and then that's signaled a move higher in price. Hammers are most affected when they're preceded by at least 3 or more declining candles. In this drawn example here, there's only one previous bearish candle. If you had seen 3 previous bearish candles or black candles going into this hammer candle, then they would have been or potentially could have been more effective. Now, just talk you through a chart here. This is a 60-minute chart on Aussie dollar. It was taken back some time ago in steadier times when I put together this presentation originally. The hammer has a small blue body, as you can see on the chart there, which has been highlighted here. And the bar is closed near to the highs. So the high and the close of the candle are near the same price. We had some bearish candles preceding this hammer candle, and then obviously the formation of this hammer. So price is headed lower. We've gone to make a new low. We've come all the way back to close at the high of the 60-minute candle. So we can look to trade that, and how you would trade that is by placing a stop below the recent low. The hammer should signify the bottom if you called it right. Therefore, we can have a reference for a stop loss below the previous low, and we can look to target a move higher. So in this instance, we're just targeting a key level of resistance above. That gives us a nice 3.73 on our risk reward ratio to target. As you can see, we are trading in a downtrend here. We've got clearly got lower highs and lower lows until we form this hammer candle down here. And then we can look to make a speculative long trade to try and catch a bounce. So if we're taking the trade here, we would have got long at, well, the close was at 69.99. So let's call that 70. If we added on a 1 pip spread. So again, the logical place to place that stop loss is below the low of that candle. And then we're looking for a targeted move up to a recent high. So we targeted that level there, which is 70.50. So we're targeting a 50 pip target, and we've got a 14 pip stop below that low. So in sort of normal market conditions, you can have stops that are quite tight, 14, 20, 25 pips, depending on what the market gives you. At the moment, that isn't necessarily as easy because the volatility has been a lot higher. So stop losses therefore should be quite a bit wider because the ranges of these bars are quite a bit larger at this moment in time. So as we can see, this trade over the next 24 hours actually worked out quite nicely. We saw a nice bullish candle posted after the hammer candle. That added an extra bit of confirmation. And then we saw the price grind higher into the target within a 24-hour period. Obviously, that's a very good example. They don't all work out like that, unfortunately. Otherwise, we'd all be very rich. But there's a classic example of how it could have played out on an isolated basis. So we've just plucked that hammer candle out. We've no real idea if there is any supports previously that go back any further along that chart. So we have just traded that in isolation, which can be quite speculative if you're trading counter trend. So hammers themselves, they can occur on all time frames. They can occur on monthlies, weeklies, dailies, any intraday chart that you look to use. They will appear everywhere. Confirmation is usually seen when the candle after the hammer candle is closes higher than the close of the previous candle. So if you're looking for a less speculative entry, then look to make sure that the hammer candle is followed up with a bullish close above the previous close on the next candle. What hammer candles don't do, and where they are limiting, is that where you get sort of classical chart patterns like head and shoulders or flags or ranges, they can give you an indication of where you can expect the measured move to go. Hammer candles don't provide any price targets. So obviously you need to figure out the reward potential for yourself. And doing that on hammer candles alone obviously can be difficult because they don't tend to offer that. So you need to be clear in your mind and on your charts where you're looking to target on the upside with take profit levels, or on the downside take profit levels as well. And like most candlestick patterns, they don't work best when they're used in isolation. The previous example I showed you was a very speculative trade indeed. We were trading against the trend and we found a hammer candle to potentially trade. They don't tend to work best when used in isolation. So where should you be using them? When I put this image together on the previous webinar that I did on engulfing candles, and this just gives you an idea of where you can look to use them in combination. So Fibonacci retracements or projections, classic support and resistance, horizontal support and resistance lines, trend lines, pivot points if there's something you're familiar with, and also moving averages. So you want to be seeing your hammer candles line up ideally with some of these levels that you've previously drawn in order to give you that added bit of confirmation. So just going to go through the technicalities of the speculative entry using the hammer candle. This is quite similar to the chart that we had on Aussie dollar. So we're coming from a downtrend. We found some support here. We've pushed higher and then we've head back towards this key support level. This is when I tend to like to use them if you've got a support level that's been identified. So let's suggest that this support level that we've got here is a Fibonacci level, or in fact, that should say support, a horizontal support level that we've identified. We've come into this level. We've made a new low. The buyers have seen that this is probably overdone, or what you might be getting here is a trap where the support levels held here previously. We've flushed out a few stop losses here for people that have taken positions here with stop losses just below. We've flushed them out, we've trapped them, and we've formed a bullish hammer. So we've come all the way down to new lows. We've fought all the way back to close at the high of the period. Once we have that candle in place, we can then have our risk below the candle. So this is where our stop loss will go, and we can target our reward on the upside, which in this instance just targets the previous swing high. So we've got a good risk reward. As you can see, the risk candle would fit 2 or 3 times into that reward candle. And that's a good setup to take there on a speculative entry by trading a hammer candle. Now, if you're looking for that additional confirmation, as I said earlier, often what you would need to see is that the candle after the hammer candle closes above the close of the hammer candle itself. That will give you a confirmation candle, and therefore you can be a little bit more confident that the price is going to head in the direction that you want. What this does, though, is reduces your risk reward potential, because obviously we're now getting entering the trade up here rather than on the close of the hammer candle itself. We've got a little bit of extra risk there as a result. So the risk is larger, and therefore the reward, if you're targeting in this instance that previous swing high, is diminished because the stop loss is quite that bit bigger. But as long as it's above 2 to 1, then it's still valid in my opinion. And again, apologies for that same resistance. That should say support. Now, they can also be used as a warning candle. So if you have taken a position, let's say you've taken this trade, you've traded on the bullish hammer, you've taken a speculative entry, you've bought at the close of the hammer candle, and then we're heading higher towards the take profit level, which I've extended in this instance, which is up here, targeting the low there. If you start to see the price heading in your direction, but price fails ahead of the resistance level, and this can be said for any trade that you're in, if you start to see price fail ahead of your take profit levels, and you start to see candles like engulfing candles or hammer candles start to form, then don't wait for this to come all the way back here. Use that as a signal to close your trade. If you think about how this looks from a risk reward perspective, let's just get a pen. So the risk reward, so we've obviously gone up here, we've come just a little bit shy of the take profit level, but then we've formed this hammer candle. So from here, I don't know where your stop is, but obviously if you've left your stop at the original point, you're risking all of this in order to try and make this. So from a risk reward perspective, we're risking what, maybe let's say 20 ticks, but we could be risking 80, which just doesn't make any sense. So I would always look to move my stops up along the way. And I've obviously got my own methods for doing that, which I can quite happily share on another webinar. But in this instance, if you've seen this form or any other sort of reversal candle form, then that should be a cue really to come out of your trade, because, you know, closing it there, you're saving yourself all of this, you're making profit regardless. But obviously you're coming out just ahead of your target, but a win's a win at the end of the day. And the risk reward profile at that level, you know, it really isn't very good for you to continue holding on to the trade. So something to bear in mind. Look to use them as signs of potential exhaustion on your own trades. And if you start to see these sort of candles form when you're already in a trade and it's happening ahead of your take profit levels, then look to use that as a warning sign to get out of your trades that little bit earlier and make sure that you make a profit. So that pretty much concludes the slides on hammer candles. As always, feel free to get in contact if there's any questions that you have about anything. Skype, phone, email, Telegram, totally up to you guys. Hopefully that was useful, and we will be back again very soon with some more content. Enjoy the rest of your day.